Do you want to deal with tenants waking you up at 3 in the morning with a call to fix a busted water heater? Yeah, me neither. So we're not even going to talk about that in today's video. Instead, we're going to discuss how you can invest your money in residential real estate passively, not actively, but still get some great returns that you will never get in your 401k. Hi, my name is Dr. Jeff Anzalone. I'm a periodontist, real estate blogger, and author. And when I'm not writing or working on these videos, I'm actually in the trenches investing in real estate as well. Currently, I'm invested in 8 passive real estate syndication deals that are actually providing my family with some incredible cash flow each month. And best of all, I don't have to deal with any tenants, headaches, or any other problems that goes along with being a landlord. How? Well, that's exactly what I want to talk to you about today. Exactly what it takes to get started with passive real estate investing. Now, I first realized after a minor snow skiing accident that I needed some other sources of income besides just what this practice is providing our family. Why? Well, what happens if I get sick? What happens if I get injured? What happens if I can't use my hands? That's right. I would be out of business and I would be unemployed. Now, but after studying what other millionaires do with their money, I quickly learned that millionaires had an average of somewhere between 6 to 7 streams of income, and the majority of their money was being made in something that at that time I was totally not in, real estate. Except back then I only had one income stream, and then the only real estate that I owned was the house that I was living in. So as you can imagine, after I learned this, I naturally gravitated towards learning more about real estate. And the more that I learned, the more that I learned from my friends, especially the ones that were landlords that were actively investing, the more horror stories that I kept hearing about actually how bad it really was. And luckily, I stumbled on to something called passive real estate. So my goal today is to basically talk about the different ways that you can invest in real estate because you're a busy professional using mainly passive real estate methods. So first of all, let's talk about number one, if you're in the right place. Now, if you'd rather not work your job or in your career or whatever forever, and if you have an endpoint in mind and it's sooner rather than later, then you're going to get some great information if you stick with me today. Secondly, if you want to retire on your own terms, whenever you want, and not what the government, what the IRS tells you or anything like that, that they're the ones that tell you when or when you can't access your money, right? If you're in a 401k or something like that, they're the ones that typically tell you when you want to retire. But if you want to retire whenever you want, then again, I've got some great information. Because many people get into real estate not because they just want to quit their job and be lazy or anything like that, but maybe 10 to 15 years down the road, they don't want to rely on strictly on some sort of social insecurity program or Medicare or whatever other type of government program there's going to be at that time. So if that sounds anything like you and you want to retire on your own terms with options, then hopefully today you'll enjoy what I'm going to tell you and get some really good stuff out of it. And the third reason people might like this and want to get into real estate investing is because they want, like myself, extra income streams coming in. And that way they can live an extraordinary life now and not have to wait until they're 70 or older. But now you have it. Those are really the top 3 reasons people get into real estate, because they want to quit their job or retire early. They want a good retirement, or they want extra cash flow. Now, what you're going to learn today are my 3 favorite strategies for passive investing. And what I'm going to be talking about, it's not easy, it's not fast, but it's not complicated or impossible either. I mean, I've been doing it since 2016, 2017-ish. And this is just real life stuff that thousands and thousands and thousands of people have been doing for hundreds and hundreds of years. Literally, these strategies have been around as long as there's been people that have either bought or sold property. And something that I don't want you to think this is, I don't want you to think that this is some sort of late night infomercial, get rich quick scheme, because it's not. And it's going to take hard work, just like everything else in life. But there are ways to make it easier for you as you're busy with less work. And we're going to talk about that a little bit later. As that's one of the things I love about real estate, is that the more that you learn, the more that you can make. All right, you ready to get started? Let's begin. So, our agenda today, first of all, I'm going to tell you a little bit about me and my story, and then we're going to get into all about real estate investing, specifically why real estate. In other words, why put your hard earned money into it? Now, I understand that there's tons of options out there for you to invest your money in. So, why should real estate be one of them? Next, I'm going to get into the 4 wealth generators of real estate, as you may or may not know that real estate can generate wealth in 4 distinct ways. Then we're going to dive into all of these along with some of the different strategies that more or less use all 4 of these different types of generators. Next, I'm going to discuss the 3 very distinct ways that you can invest in real estate, along with some tips, some basically actionable tips for what you can do to get started with it today if you choose to do so. And then finally, we're going to talk about some different tips and tricks that I've used to minimize the amount of work that I put every day, every week, every month into real estate. Now, I understand that you're like me. You get up, you're working at your full-time job, and time is very valuable and important for you, especially if you have kids like me. So I'm going to talk to you about how I'm able to balance both work, family, and real estate, and to do this successfully and still find the deal flow that I'm able to do. All right, first, very, very briefly, a little bit about me. Again, my name is Dr. Jeff Anzalone. I'm a full-time practicing periodontist here in Louisiana, and I got into passive real estate investing after realizing that it was very risky to be living off of just one income. Because if I couldn't work due to an injury, due to sickness, something like that, then my family would suffer. And I noticed that the majority of millionaires had several income streams, mainly from real estate, which started me down that path. And today I'm actually invested in a little over 1,000 units in multifamily apartments, and also in 2 hotels as well. And I'm constantly looking around to seeing what I can invest in each year. Now, I'm not the guy that's going to tell you to fix your job, or to quit your job and to become some sort of wholesaler, or start flipping dozens of houses a month with your spouse or anything like that. That's not me. I'm here talking to you about taking the excess money that I'm taking out of my dental practice, and also taking the distributions that I get every quarter from these passive income investments, and taking all of that and pooling it together to reinvest in new properties. That's what I do. So again, my goal is just to keep investing my money, and hopefully keep getting a great return on it, and trying to keep building that up. So hopefully you can identify with that. Again, I'm the CEO of debtfreedr.com, which is a blog, and also recently started this YouTube channel that you're on. Thank you for being here. And I'm going to put both of the links below this video for you to check out. Now, our family absolutely loves to travel, which is another reason why I was attracted so much to real estate, as it's able to free up my time to either hit the beach, or probably my favorite place on earth is the Rocky Mountains up in Montana. Again, real estate makes this possible to have this type of freedom that we can have and travel and enjoy our kids, because as you know, if you've got 2 teenagers like we do, they grow up fast. And really, because of all the positive benefits that I've seen firsthand in my life, it's the reason why I not only love investing in real estate, but it's also why I like teaching this stuff online to you, because of how passionate I am about it. And I have to attest, it's very addicting, and it's also cool teaching these concepts to kids, as most of the time they'll actually catch on to it or get it quicker. They'll register it quicker than we do as an adults. And so today, I want to show you guys how you can do the same, how you're going to be able to invest your income into real estate and start making some fantastic returns. So if you're ready, let's get going. All right, first of all, let's get into the topic of why real estate. Why should you invest with it to begin with? Well, number one, what I love about it, it's tangible, it's physical, it's something that you can actually touch. And I really love the fact that I can go by and I can drive and take a look at what I own. It's a physical thing, and it's not like, like a sheet of paper or something like that, like a share of a stock in a company, or, anything like that. And don't forget, there's tons of diversification within the real estate asset class as well. There's literally probably hundreds of different ways that you could potentially get into the real estate investing asset class or realm or whatever. It just depends on what you like. So you could flip houses, you could buy apartments, you could purchase single family homes, self-storage, wholesale, tax liens. There's all sorts of tactics for using real estate to generate wealth for you and your family. And also, you're not just relying on one thing. Even if all your eggs were in one basket, like real estate, you don't have to rely on just one asset class within real estate. You could be in a little bit of commercial, a little bit of industrial, a little bit of residential, or whatever. That's what makes real estate so cool. And number two, it's very actionable. Now, unlike the stock market where it's going to go up and go down, go up and down, you literally have zero control over your investments. But with real estate, it's directly actionable. This means that you can personally affect the return on your investment, not just putting money in and out of a stock or something like that, but you can actually affect the return. Now, what I mean by this is, you can go out in your area or whatever, and you can purchase a property if you want, and you can fix it up. Or you can hire a contractor to go and maybe add a new bedroom, or to remodel the kitchen, paint the outside of the house to bring it up to the standard of the other properties that are around the house in the neighborhood. Now, think about this. What you're doing is you're adding value. So whoever is renting it from you, you're adding value to your tenant. Something else that you can do with that property, or again, get somebody else to do it for you, you can run it better, or you can manage it better. You can cut expenses. You can increase the income, because real estate is combining the business aspect of running a business with the idea of an asset that you can invest in and just put your money in. And so it's very forgiving in that way, because again, it's directly actionable. But remember, you can do all of this yourself, or if you're like me, get somebody else to do this, and you can just sit back and reap the benefits. Number three, why real estate? It's improvable. Like I just mentioned, you can go in and you can improve a property to make it worth more. And this is especially true within the commercial real estate space, which we're going to get into in a lot more detail later. But such as things like apartment complexes, as they're actually valued based on the income that they bring in, and not what the other apartments or the comps are around them. So if you're interested in investing in an apartment complex, an improvement, and improvements are made to it, like the lighting, the landscaping, update the flooring, appliances, all that kind of stuff. When you do that, then you can turn around and raise the rent on each unit. And by doing this, you can increase the value. You can increase by hundreds of thousands of dollars in value, because again, it's improvable. You can fix it up. You can buy something that's older and then improve it. But guess what? You can't do that if you invest in a stock or a mutual fund or something like that, right? You have absolutely no control over what Apple does or Tesla or anything like that, but you do with real estate. Number four, you can also get some really, really great returns if you get into real estate. I mean, let's be honest. We invest our money because ultimately we want to make more money, right? And I believe that you can make incredible returns with real estate, especially if you're willing, again, to invest the time and learning the processes, learning how to make this happen. Because remember what we talked about? The more you learn, the more you can make. And the more you learn, the more you make, the higher return you can make as well. I cringe when people email me and they'll come to my site and they'll email me telling me how much cash they have just sitting around in a checking account or a savings account or a money market account, something like that, because they're, quote, scared to invest. These people are making like 0.0001% on their money. And that's just think about it, that's a terrible way to go through life, living in this fear the whole time. Now, I personally go for investing in deals that have the actual potential. When I put my money in, if I'm in a project that goes, let's say, they're going to hold like an apartment complex for 5 or 6 years before they sell it. I'm going in to where I can potentially double my money. So I put in $100,000, 5 or 6 years down the road, I've got $200,000. And what'll happen is with these people, I'll look up 10 years from now and I'll double that money and then double that money again. Where what are they doing? They're just putting money in that savings account, in that checking account, in that money market account, living in fear. No thanks, not for me. And number five, you have numerous options with real estate. And that's kind of like diversification a little bit I mentioned earlier, but there's just many different ways to get into real estate. And it's just crazy how much of the different ways that you can do this, because there's so many different options for you to be involved with real estate. All right, so let's now move on to probably one of my favorite topics when it comes to real estate, and that is the four wealth generators of real estate. And I mentioned earlier that there are four distinct things that I find that help to produce a return in real estate. And one of the things that I love about real estate is it's not just one way to make money. There's actually four. And here they are. Number one, you can generate income in real estate through cash flow. And this is what really attracted me to real estate probably the most, and usually attracts people the most to real estate, because this is one of the biggest benefits of being in real estate. Unlike other types of investments, real estate generates passive cash flow, whether you go and treat patients or go to work or whatever. It's sending you money every month or every quarter or whatever. And it's simply what's left over from the money coming in via the rents that the tenants pay you each month minus expenses. So a positive cash flow, you have a surplus. A negative cash flow, you have a deficit. So for instance, if you're invested in an apartment complex that collects $20,000 a month and the expenses are $12,000 a month, then your cash flow is $20,000 minus $12,000. Your cash flow is $8,000 a month. This is what they call mailbox money. And this is what is ultimately going to provide you financial freedom. Because if you're in that scenario, if your personal monthly expenses are $8,000 a month and the cash flow from your apartment is the same, guess what? You're officially financially free to do whatever you want. If you want to quit your job, if you want to change careers, if you want to cut back from full-time to part-time, if you want to go start a charity, mission, whatever you want to do, the choice is yours when you're financially free. So that's number one. The second wealth generator is appreciation. Now, when investing in real estate, your money also goes to work for you in this form called appreciation. Now, if you're a homeowner now, or if you've sold a home before, or if you've sold a home that you've owned for several years, then more than likely you receive probably more than you paid for it. That is appreciation in a nutshell. It's the concept of the property's value increasing over time. An example would be if let's say you bought a property for $80,000, and then a couple of years later it's worth $100,000, or you bought a property for $50,000, and a few years later it's worth $80,000, or if you bought a big apartment complex for $500,000, and then a few years later it's worth $750,000. That's pretty cool, right? Now, there's two sides of the appreciation game. So there is natural appreciation, and then there's forced appreciation. So what's the difference? Well, natural appreciation is what happens because of the local market, wherever that property is. And it's largely driven by things like inflation, supply, and demand. So the market is going up, the market's going down, it's going up and down all the time, right? Probably like that in your area. It's either up or it's down. And if you buy it on the bottom and then you sell it at the top, then you get to take advantage of the natural appreciation. And the second half of the appreciation equation is something called forced appreciation. And we just discussed this regarding that if you could increase the monthly rent on your units, because the property, remember, the property's value is based on how much profit it makes on a commercial property, which means that you're able to, remember, you can renovate the apartment, and then you're able to forced appreciation, you're able to force up or raise the value. So in a nutshell, it all stems from making a property nicer to live in. Now, let me use a simple example regarding what we can all relate to, and that's probably something that you've either lived in before or you live in now, and that's a home, or like a single family home. So if you were to buy a house for, let's say, $120,000 that needed some work, and you hired a contractor and you paid him $40,000, so 120 grand to get in, 40 grand the contractor, so you would be all in for 160,000, right? Okay, but think about this. At that point, after you renovate it, that property is not worth $160,000 at this point, because more than likely that property is going to appraise more. It could appraise for just under $200,000, again, because of this forced appreciation. Now, think about this. In a way, you didn't actually force it. What you did is you actually brought it up to the level that it should be, but it's the same concept. And it was worth this because maybe before it was a dump when you bought it, and you've made it better and you've put more equity in the property. And equity, what that is, that's the spread, that the money that I've got, it's that value. And someday I'll realize that spread whenever I sell it. I'll get that value out and I'll be able to spend that or save it or whatever. So again, that's the second wealth generator, appreciation. Now moving on to the third wealth generator, is something called amortization. And that's nothing more than loan, also known as a loan paydown. Now, what that means is you have a tenant that's in your house, that's in your apartment or whatever. When they pay monthly rent, they're actually helping you pay the mortgage down. It's really like automatic wealth building. All right, here's a very simplified example for you. Let's say that I bought a property and I paid $100,000 for it. Well, let's say I bought it for $70,000 and then I put $30,000 into it. Okay, 100 grand. So now I go out and I get a new mortgage and my loan is for $100,000. Okay, so let's just say hypothetically that the property was only worth, even though that I increased the value, I fixed it up, it's still only worth $100,000 when I got done with those improvements, which we know, again, we force the appreciation, it would be worth more. But again, for our example purposes, I want to keep this as simple as possible. So let's say that the price never got any higher than that. We never got any appreciation. It just stayed at $100,000 for as long as you owned it. And let's just say, again, hypothetically, that the cash flow on the property was zero the entire time you held it. So I never got a penny extra in cash flow. And at the end of every year, it was just always canceled out at zero. Okay. So all I got during this period, let's say I had a 30-year loan, all I got during this period was the loan being paid down every month. Well, guess what? After 30 years, I'm going to have a property that's worth $100,000 because it's still worth the same level, right? We're hypothetically saying that my tenant that's in there paid it down every month. So I didn't have to save up. I didn't have to go and, like some of these people say, pay all cash into real estate or whatever, save up your money. I didn't have to do that in this case. If you want to, go for it. There's different options out there. But in this scenario, you didn't have to wait and save up the $100,000 to buy that property, because my tenants basically saved me from doing that. They saved me $100,000 on purchasing the property. So again, real estate doesn't operate in a vacuum. Prices do go up, but they also do go down. We do get some positive cash flow, but in our scenario, we also get some negative or just flat or no cash flow. Again, things do happen, but just to understand, that's one of the reasons why this loan pay down is it's a major wealth generator of why you should get into, or why you should consider real estate. Which takes us to the last one, which is very important for you, especially for those the high income, high tax paying people, and that is the tax savings that you're going to get whenever you invest in real estate. Now, before we go any further, again, I'm a periodontist. I'm not an accountant or CPA, anything like that. So if there's something specific that you want to ask you, or that you have about taxes, specific questions, something that you're going to do that you need to know, I would recommend that you contact your accountant, or if you do not have one, contact one, or a tax attorney. What I do want to do is provide a brief overview about some of the different tax benefits that you can get from investing in real estate. As really, there's a lot of there's a ton of tax benefits out there in real estate, because think about this: the government and in the tax code, the government incentivizes property owners. They love real estate investors. Why? Well, it's because we're helping to supply housing to millions of Americans, and the government wants to incentivize this good behavior. And they don't want to be landlords. And the way that they incentivize this behavior is they give out these tax savings and tax breaks. So let's take the cash flow. All right. So let's take the cash flow that you're going to be getting on your investment, whatever you're going to invest in. Now, on that cash flow, you don't have to pay self-employment tax. In fact, you're paying a very low tax rate on all of your real estate because of all these different tax incentives you're going to get. And additionally, the cash flow that you do get is typically wiped out by something called depreciation. You've probably heard this before, but I can go into a lot of details about this, but I'm not going to, because that's a subject for a much longer conversation in the future. But the gist of it is basically, over time, wear and tear lowers the value of a rental property and the contents in it. And the government, this whole process, this wear and tear, the government allows this process to be tax deductible. And this whole process of it doing that is called depreciation. Now, this deduction can either be taken for the expected life, the expected entire life of the property that you invest in, and typically it's spread out over multiple years. Again, depending on if you're doing commercial or residential, or whatever. So again, your CPA can assist you with this, but again, it's one of the main reasons that the ultra wealthy that you're always hearing about that never pays taxes, this is one of the reasons why they do it, is because of depreciation. So the bottom line is this: if you have two people, say me and my friend Daniel, And Daniel makes $70,000 a year, working at his job, whatever he's doing. And I, as a real estate investor, make $70,000 a year in cash flow. He's going to work. He's making 70 grand. He's working for the man. And I'm making 70 grand in cash flow. Question: me or Daniel, who gets the most money? Who gets to keep the most money? Well, I can tell you now, by far, I'm the one that gets to keep more money than Daniel, who's an employee. Sorry, Daniel. Or what about Emily? Emily's a business owner. Emily owns a business and she makes 70 grand a year. But again, I'm the one that gets 70,000 a year in cash flow. She's a business owner, not the employee. She's self-employed. All I do is just own real estate that pays me 70 grand. Again, who gets to keep more money? I do. So because I'm a real estate investor on cash flow, I'm making more than Emily and Daniel, who are employees and who are self-employed. They're thinking that that's what they're supposed to do. You're supposed to go to your job, work hard, pay taxes. You're going to be making the most money. But again, it's not so much how hard you work, but how smart you work. So $70,000 income in real estate, it's worth probably equivalent of probably $95,000 to $100,000 in either a self-employed business owner or an employee. So again, those are the four different wealth generators: the cash flow, natural and forced appreciation, amortization or the loan pay down, and the different tax savings such as depreciation. Next, I want to talk about the three strategies that you can do, some things that you can do now to get started into real estate. And again, this doesn't matter if you're somebody that's new or you're an advanced investor. All this works just the same. All right, so number one, let's talk about investing in probably what you're most familiar with, and that's single family home. Now, that's probably out of everything out there, that's probably the easiest one to define, because single family investing is when you just go and you purchase a single family home and you just rent it out. Now, I know what you're thinking, Jeff. I don't want to deal with tenants. I don't want to get phone calls at all hours of the night. It's okay, because we're going to talk later about how to make this whole process, this single family investing, much more passive. But for now, let's just understand, just to keep this simple and just keep this basic, that you can buy single family homes and that they can work for some people. Actually, many people that are really big real estate investors, they actually got their start with purchasing just one single family home. And one person that actually comes to mind that I can think of that actually started like this is Grant Cardone. He bought a real small single family home in Houston that got him started to now doing nothing but these huge apartment complexes all over the country. So let's briefly talk about why people get into this single family home space to begin with. So number one, they're everywhere, right? They're somewhere in the neighborhood of, I don't know, probably 200, 250 million homes out there in the US. They're everywhere. Everybody's got a house, or at least everybody wants to live in one, which leads us to the second benefit. They're easy to understand, right? People get houses. They understand houses. They're not complicated to comprehend, because probably most people have lived in one before. Third, they're easy to sell. Now, what I mean by this is that they're easier than a lot of other investments. Some of the ones that we'll talk about here in just a minute, out of all those, are probably the easiest to sell. Why? Because again, there's hundreds of millions of Americans that want to live in a house. And so they're easier to sell than a lot of those other things out there. Fourth, the financing for a single family home, it's a lot more simple than some of the other financing out there. And one of the more popular reasons people invest in real estate in general is that they can use what's called leverage. And another word for getting leverage is getting a loan. So again, the financing, it's fairly straightforward and simple, because really at some point in people's life, if they buy a house, more than likely they're going to get a mortgage on it, right? So think about it. You go to your lender, you go to the bank, you go to credit union, something like that. You put down a down payment, and for something like this, you go, you put your down payment down, you get the investment property, like the single family home, and then the loans for these are very similar to your home loan, that you got whenever you bought the home that you live in now. All right, number five is that just like the wealth generators, you're able to get from the single family home, you're able to get cash flow, and you're able to get appreciation. Typically, single family homes, they tend to rise in value better than some of the other different real estate investments out there. Also, as long as you buy right, you can also get some pretty decent cash flow. And again, everything that I'm saying today, everything that we can preface from here on out is as long as you buy right. You make money, you probably have heard this before, in real estate, you make money on the buy, which again, all goes back to educating yourself more and know what you're doing before investing your money. All right. Number six, single family homes, they're a lot easier to manage than some of the other properties out there. Some of these investors, they've found, for the most part, that their tenants, they typically tend to take better care of their properties. So it seems that, whenever somebody rents a house, they will get this sense of pride or ownership. And because of this, they'll take better care of your property. All right, number seven, single family homes, they're very easy to improve. Now, what this means is that you can buy something, again, that's run down, fix it up, improve it, and turn it around for a profit because you've focused on and you've made a point to increase its value. All right, so let's talk about this. You purchase one of these, you rent it out. What kind of returns are we talking about making? So, again, let's go through an example that I think will help you understand this better. And again, just like everything, it all depends on the deal and it all depends on the type of leverage that you use as well. Remember that regarding leverage, I'm talking about the loan that you get to purchase the property. Now, when you do this, you're leveraging a bank loan and using a small amount of force or a small down payment to apply to a bigger purchase. Kind of like if you're wanting to move a large rock, you want to put a small amount of force can move something big. And when you do that, when you use that, you're able to typically see a higher return on your investment when you use this leverage. Not always, but the majority of the time. So again, what types of returns can you maybe expect? So let's just do a quick example. Again, we're going to stick with a single family home. And what we're going to do is you and I are going to go in and we're going to purchase a single family home together. Okay. And we're going to pay $150,000 for it. We're going to put 20% down, which is $30,000. And let's just factor in that we're going to have about $5,000 in the closing costs. So for this particular property, let's just assume that there's no rehab that needs to be done on the property. This is just go out, purchase a property, own it. So total, we're all in for $35K. You're with me so far? Good. Okay. So next, let's assume that we're able to rent this property for $2,000 a month. So we rent it out to a family. Let's say we had a family move into town last month that goes to your church with you. They're a great family. They need a place to stay while they're, because they're new to the area. They're not really sure where they want to buy a house. So they choose to initially rent from you to get to know the area before they make their big purchase. Okay. So the expenses on your house with you and I are $1,600 a month. So that means that we're both we're splitting the difference. Now that's accounting for everything. When I say expenses, that's accounting for the vacancy, that's accounting for the repairs, maintenance, all of those CapEx or capital expenditures that you have to usually set aside this kind of money for the reserves. And, just like for the water bill, if you have to pay for one, But again, with single family homes, typically the tenant will pay for all that. They'll pay for the utilities, things like that for you. So it's actually pretty nice. So many times we don't have to cover most of these, but we will have to cover the taxes, the insurance, and the mortgage payment. So after it's all said and done, that's going to come out to being $1,600 a month. Now that we know these numbers, we realize again that you and I, we're netting $400 a month, $2,000 minus the 1,600 in expenses, 400 a month. If we take 400 a month and we multiply it times 12 months, well, each year we're cash flowing $4,800 a year in cash flow. Again, that's after everything is said and done. Our total profit at the end of the day is $4,800 a year. Now, if we use some very basic math and we take the $4,800 and we divide it by our initial investment that we had together of $35,000, again, it's a very simplistic way of looking at this, but we actually get a 13.7% cash on cash return. Now, again, this is just the cash on cash return, which means remember the four wealth generators that we have. It's just the cash flow return. This is not looking at the appreciation, the loan pay down, and the tax benefits. This is just only one of the four ways that we can make money in real estate. And if you want to get real fancy, then you can get into what's called an IRR calculation or an internal rate of return. It's going to factor in all of these different things, of the other wealth generators. But again, we're not going to do that now. We're going to keep this very simple today. So let's just say our total return on the deal roughly is about 13.5%. Again, that's a very simplistic way of looking at it, but it's enough for you and me to be able to decide if we want to buy a property again together. And whenever we were looking at this, we come up with these different numbers. And that's what you can actually look for as long as you have these income numbers and your expenses. And then once you have these numbers, again, educating yourself, you can make a fairly good decision about moving forward. All right. So that's all about investing in single family homes. So now let's move on to the second way that you can get started, and that's by investing in these smaller multifamily properties. Now, these are for properties that are anywhere from 2, 3, or 4 units. And when I was in my residency in New Orleans, my wife and I, we lived in we lived in a fourplex. So for 3 years, we were paying $750 a month to live in that. So 3 times 3 years, that's $9,000 or $27,000 over that 3-year time period. That was a good chunk of change. So let's discuss what's good about these types of property. So the first thing is there's very little competition. And let's face it, when you look at the real estate market, in your area, probably I know in my area, there's just not as many people looking for a duplex or a triplex or a fourplex as there are going to be for a single family home. It's almost like there's something that clicks, like, oh my gosh, there's more than one tenant renting from me. We're not even going to go there. So this is really great because, again, this really decreases the amount of competition that you have. So you can really start to narrow your search. And if you really start knowing your area, you can actually become an expert on these smaller types of properties. The second reason is the potential for much higher cash flow. So you remember earlier when we talked about the single family deal where you were making about $400, you're netting about $400 a month on that house. But that's not bad. But what if you could make let's say $250 a unit per month if you bought a fourplex? So now you're looking at $1,000 a month coming in cash flow. So overall, again, you have a much potentially higher chance for cash flow. And the third reason would be the economy of scale. Again, Grant Cardone talks a lot about this, when he's talking to like people that are just now getting into real estate, new investors that are just insistent on, I've got to start with single family homes. Because again, he's really big, and I agree, it's just hard to scale that model. So who wants to invest and deal with 70 single family homes when you could just have one apartment building, with just one roof, or maybe two buildings instead of 70 single roofs that you got to replace every 12 to 15 years. So with the fourplex, you've got, as you've got one roof covering your entire property. So you'll just pay the 10 to 12,000 bucks to replace it instead of all these single family homes that you would have to have. And more than likely, if in your fourplex, you're going to have one electrical service coming in or one plumbing service or whatever. So again, these economies of scale, they can save you a lot of money when you're dealing with a lower number of buildings versus just that one single family home to take care of. And the fourth reason is the financing is easier. It's more simple. And what I mean by that regarding the financing for like a small multifamily piece of property, and again, it doesn't matter if it's a 2, 3, or 4 unit, it's going to be identical to if you went out and you purchased a single family home. Because most of the banks, they don't really differentiate between a duplex or a triplex or a fourplex from a single family home. So the numbers are the same. Doesn't really matter to them because it's all residential, meaning it's going to be a lot more simple. All right, so if you were to invest in one of these properties, what kind of returns can you get? So again, all this depends on the deal. So let's just briefly walk through an example, and we'll come up with some numbers. Again, I'm going to keep this as simple as I can, but let's take a look at, let's say that you purchase a fourplex and you purchase it. The price is $250,000. All right, and for this particular property, you're going to put $50,000 down, plus you're going to put closing costs and all of that, and fees, and anything else. So we're looking at $60,000 total. So let's assume that the total rent for this property in all 4 units is, and we'll put rent right here, $6,000 a month. All right, follow me so far? So we're averaging, we got a fourplex, we're averaging $1,500 per unit, which is, nothing out of the ordinary. So now let's assume that the total expenses on this property, let's say the expenses are $5,400. So there's your expenses. So then basically you just take our income, subtract it from that, and we have our cash flow, $600 a month. And $600 a month times 12 months, that's $7,200 a year. And then doing, again, that simple math calculation, basically you take the amount of money that we made in the year, the $7,200, remember? And then we divide it by the 60 grand. So 7,200 divided by $60,000, and we're going to come up with 12% cash on cash return. And again, cash on cash return, remember, that's not counting, remember those, what we talked about before, that's not counting the appreciation, that's not counting the tax benefits, that's not counting your tenants paying down the loan for you. Because remember, all of those things are going to help. You remember those 4 wealth generators, because we're just focusing on the one thing, the cash flow, the cash on cash return. Now you may be asking yourself, well, okay, Jeff, how do I get started if I wanted to potentially get into this type of investment? Again, it's similar to if you want to start with a single family home. So one of the ways that you can do this is you can contact, if you know of a local real estate agent in your area, and what you can do is give them your email address, and you can ask them to set up automatic alerts for any type of property. With this one, for small multifamily properties that are within your area or wherever you want to invest in, that are going to match the criteria that you're looking for. Again, you can do this for single family homes as well. Next, what you want to consider doing is learning how to properly analyze a multi-unit property. Now, there's a lot of the expenses that people are, whenever they go and take a look at these, there's a lot of expenses that people are forgetting to account for. So make sure that you educate yourself and you know about all those. And then be a good idea to speak with any local lenders in your area to find out what are some of the different financing options are. Make sure you always talk with several of them, because you want them to be the ones that are competing with you to get the best rates. Because I had a patient that has multiple units in our area, and he was always big on telling me, "Yeah, I've got this bank. I told this bank this, giving me this rate, and this bank this rate, and now they're fighting over my business." So that's what you want. All right, so let's moving on to number 3, which is my favorite, and that would be the apartment complexes. Now, this is any residential. So when we're talking about this is any residential greater than 4. So five or larger units, we're going to consider. This is where you go from the residential to, quote, the commercial. Now, so let's discuss what's good about these. Number one, there's far less competition. And think about it, there's a lot less people out there that are thinking about buying an apartment complex than there is that are going to be buying a single family home. Number two, remember we talked about this earlier, the value is based on profit. So I mentioned earlier that when the profit goes up, remember the value goes up. So if you pay, let's say, $750,000 for an apartment that's only 60% occupied, and you go in, you rehab it, you do renovations, then remember you can increase the rent, plus you make it more attractive to get more people. Hey, that's a nicer looking apartment now. I'm going to go rent and live there. So you're going to raise the rent, you're going to make it better, you're going to attract more people, you're going to attract more tenants, you're going to raise that occupancy. And then after this is done, it's going to be worth much more, remember, than you paid for it. So how do you improve the profit? Well, you can either decrease the expenses or you can increase the income, or both. Again, you can lower your expenses or you can increase the income or the rent, or both. Now, when improvements are made, the income increases, and you can also manage it better, or better yet, if you don't want to do it, find a manager that can manage it effectively and efficiently. Then think about it, the more efficient somebody can manage it for you, the lower your expenses. I mean, it's running like a machine. So owning an apartment can be one of the most hands-off investments you can buy. And then finally, number 3, it's the most scalable option out there. So think about this. You can buy a 100 or 200 or 400 unit property much faster than you could buy 200 or 300 or 400 single family homes, right? So it's the most scalable option. You can increase this the quickest. Now, let's talk about the returns. So again, it always comes down to the deal, and again, what type of leverage that you can get. So let's go through an example. All right. So let's say that you purchased a 24 unit property, and you were to pay, let's say you paid, the price was 1.5 million. All right. And the bank had you put down 33%. We're going to keep the numbers even. So 33% down payment. And this 33% of this deal equals $500,000. and then you had to come up with $100,000 in, let's say, repairs and closing costs. So we're going to add 100,000, which brings our total to 600,000 bucks. All right. Now, you may be saying, well, Jeff, I don't have $600,000. Well, this isn't the only apartment complex, right? There are cheaper apartments out there, but remember the number one of the most sought after reasons for getting apartments was the amount of little to no competition, right? Because there's not a lot of people out there that are willing to put up this kind of money. Now, there are other ways to come up with the money using OPM or other people's money, which that's another topic for a future conversation. And if you want me to go into more detail like that, simply leave a comment in this below this video. I'd love to do that for you if you're interested. So let's just say, though, that you were able to invest $600,000. Maybe you had 600 grand in an old 401k or your 401k that you used a self-directed IRA or self-directed 401k. You took out some of that money. I mean, there's different ways to do this. You could get local investors to go in with you. So you could be creative about this. But for our purposes, we're going to say that somehow, some way, you came up with 600 grand. And then the total rent for all of these units and the 24 units, the total rent for that was $22,000 per month minus, so this is the rent. And then you had $17,000 a month in expenses. So that means at the end of the day, you're clearing $5,000 per month. Now, after management, taxes, insurance, we're going to factor in vacancy, we're going to factor in repairs. After all of that stuff, after it's all said and done, $5,000 a month, $5,000 a month times 12 months, you're looking at $60,000 per year. Now, again, let's use, just like we did for the other apartment complex, the small multifamily unit. Let's use a simple calculation. So if we take the $60,000 and we divide it by the 600, remember the 600,000 that we came up with, then that's going to give us roughly about a 10% cash on cash return. And again, that's very, very passive, because you're going to have a manager that's looking at, you're not going to want to deal with 24 headaches, 24 tenants, are you? You're going to want somebody else that's doing that. So you got to make sure that they're managing the 24 tenants, but you're managing the manager. All right. So again, it's not completely passive, but it's pretty close to it. So you've got to be the one to check the numbers, make sure that they're, not stealing from you and different things like that. So again, that this 10% cash on cash return, this doesn't account for all the other things. Remember the tax benefits, appreciation, loan pay down, all that. So this can be a really good return now, and it's going to be even better return when you factor all these in for your total return. So remember, we pay 1.5 million for this. Remember, you put up the 100 grand as well in repairs and closing costs. So my guess is probably this is going to be worth more, right? Because you've improved it. And because you've improved it, remember what we can do, we can increase the rents. So let's say we increase all 24 rents. So now instead of $22,000, let's say we increased it to $24,000 a month. So we just went up $100 a month, which isn't out of the ordinary, $100 a month to each of the units. So that's now going to give us 24,000. So that's an extra. See, that's going to be an extra $2,400 a month, right? So over the course of a year, $2,400 a month, extra $2,400 a month, you're looking at probably close to about 30 grand more a year in income. And Remember, we talked about how these properties are sold. These properties are sold based on the income that it's producing. So if you got an apartment complex and it's uh, producing X amount of net operating income, that's how, whenever you go to sell, that's the criteria it's based on. So that that in itself, with providing those improvements, that could likely raise the value of the property $500,000 or more. Again, that's how drastic it can be, because you're able to increase the profit, which allows you to raise up the value quite a bit more. So let's assume that this scenario happened, and after you paid 1.5 million bucks for it, you were able to increase the value, and now it's worth 2 million. How cool is that? Now let's assume that you held the property. Let's say you had it for 5 years, and then you turned around and somebody wanted to buy it from you. So during that 5 year period, not only were you getting the cash flow each and every month for 5 years, you were also making that 10% return. So at the end of the day, you sold it, you got all the cash flow for the 5 years, you sold it at the 5 year mark, and then you made an extra 500 grand in profit. And during that time, what happened? You were able to, well, your tenants were able to pay down your loan as well. So again, there's a lot of other reasons that you're going to get a great return out of these because of those four wealth generators. So now you may be asking yourself, well, how, Jeff, could I get started if I wanted to maybe pursue apartment complexes? So first of all, before you jump right in, consider actually taking a step back and, again, educating yourself, doing some reading. Two resources that I want to give you, two great books. The first one is The Hands-Off Investor by Brian Burke, and that's all focused on something that I'm going to get into a little bit later in this video. My favorite investment, which are real estate syndications. And then the other book is ABCs of Real Estate by Rich Dad advisor Ken McElroy. Next, you want to learn how to properly evaluate these deals, properly evaluate what it takes. And we kind of went over a real simplistic view, but if you're looking at wanting to purchase an apartment complex, I'm not saying that you need to become an expert at it, but you need to look at it to see if the numbers work out for you or not. So again, this isn't just as simple as just maybe, plugging a few numbers on the, back of a napkin. For something like this, as you can imagine, it's going to take a little bit more work to figure out what a complex, like a 24 unit, is actually going to produce for you. And then once you get the hang of it, you can start analyzing more and more potential deals based on, where you live, based on your market, or based on where you want to buy, because you may not live in an area that you want to buy in. So again, you don't have to actually buy the deals, but I want you to learn about them, start to analyze them, which you're going to learn how to do in much detail in both of these books, these references. And just like with anything else, the more practice that you do, the better that you can get. And also understand that apartments, especially now, they're one of the most sought after and popular investments in the entire country right now, because people, investors, especially out of the country investors too, I get emails occasionally from people that are out of the country, Canada, overseas, etc. They love to invest in U.S. apartment complexes. So again, the competition is really starting to go up, and you really have to know what you're doing, because there's a lot of people out there that don't know what they're doing, and they're out there buying these deals, and they're never going to make a return on it, even though that they think they are. So what you've got to do, you've got to educate yourself. You've got to be smarter than these people. All right, so if you stayed up with me, and I appreciate it up until this point, hopefully by now you're a little bit more educated on how you can get started in real estate and with the three main types of assets. But I know a lot of you right now are saying, okay, Jeff, all of this is nice, but remember, we don't want to deal with tenants, nor Do we have time to deal with tenants or fix toilets or plumbing or anything like that? We're busy professionals. We're getting up every morning. We're getting the kids ready to go to school. We're going to work. We're going to football practice. We're going to cheerleading practice. We're going to pep rallies. We're going to Wednesday night church, whatever. So who has time to deal with an apartment full of tenants? Well, the good news is no. The great news is you don't have to. That's right, because you can do as much as or as be as little involved as you want to be. You can let the plumbers do what they know best, plumbing. You can let the electricians do what they know best, doing the wiring, and everybody else, do what they know best, and you go do what you know best. You go do your job because you're highly trained in your specific field or career or whatever. You go and you make money. And the better that you become at your job, the more you can invest. And the more that you're learning, the more that you can invest more wisely in real estate. And that's what I strive to do, plus thousands and thousands of other busy professionals out there. That's what I'm trying to get the point across. So how can you invest in real estate with minimal time? Well, number one, you've got to utilize other people. Now, if you want to do this semi-passive, but you still have some involvement, then utilize people like, maybe going out and hiring a property manager. You could also go out and you could hire maybe like somebody part-time to help you as your real estate business continues to grow. Find somebody that wants to help you a little bit part-time. For instance, I recently hired a college student. She actually needs like some hours in a certain class that she's taking, a certain course. So the I was able to help her and she's able to help me. So the more you can find, the more people that you can find to help, the fewer hours that you have to spend on the menial task out there. I mean, this is no difference than really my dental practice, because I can hire people to do tasks that I know how to do. Yet, if I do these tasks, they're going to take me away from being focused on what I know best, and that is treating patients, which inevitably that is what produces the income to pay all the bills, to pay for the practice expenses, including the employees. So I can hire somebody to deal with the marketing or the payroll or things like that. Can I do them? Yes, but I'd be more productive if I didn't. So now as you continue to add more and more properties to your portfolio, you can start adding and growing your team around you. All right, number two thing that you can do is you can consider looking into turnkey rentals, turnkey real estate investing. Now you're probably going, okay, well, what is that? What's turnkey? But there's actually companies out there that will buy a property. I know there's some single family home companies out there. They'll buy property. They'll buy these single family homes. They'll improve them, or they'll build them new. They'll market it. They'll put a tenant in there for you, and they'll manage it for you. And so for you, the investor, it's almost completely hands off. It's like you don't have to do anything. And so that could be a way to do it. But again, just be careful, because a lot of these companies out there, not a lot, but some of these companies out there, they're not too good with math. Sometimes they like to fudge the numbers a little bit, and they're like, oh yeah, there's no repairs on this property, and there's never any vacancies on this property. So just make sure, again, you educate yourself, not to be an expert, but you can run your own numbers. Again, those two books that I referenced, that could be a game changer for you if you really get to the point where you know that information, and then you start looking at what deals to potentially get in and how to evaluate a property. And then the other option that I mentioned earlier that's becoming extremely popular are the syndications deals. And probably out of everything, these are about as completely hands off as you can be. And as I mentioned, Brian Burke's book, The Hands Off Investor, if you were to read that book, you would probably know more than 85 to 90% of the people that invest in syndications, because it's geared specifically for that. So the investing in these syndications, it's similar to if you were to put your money in a mutual fund. And so think about it. Once you invest in a mutual fund, you put your money in, do you have to do any more work? No, right? It's almost like, what was it, that set it and forget it commercial back in the day? So it's like that. The work is actually done on the front end by finding a sponsor group that are going to find the deals and manage the deals. So that work's done on the front end. You invest, and that's it. Because the sponsor group or the general partner, they're the ones that are doing all the work. Again, they're finding the deals, they're arranging the financing, they're marketing, they're constantly marketing it to keep it filled, keep the property filled. They're collecting the rent, they're doing any repairs, they're performing upkeep, they're basically doing everything. And the only work that you have to do is just either get your check from the mail or make sure that they've deposited in your account each quarter, and that's it. So I know that I've covered a ton of information today, but I wanted to really start with the basics. And we covered everything from the three strategies that you should consider getting into. Remember, we talked about the four wealth generators. We talked about how to do real estate more passively, and then we talked about some of the different tips that you can do that. Now, I understand that this whole video today is all about an introduction to real estate investing. So if you want to know more about it, you're actually going to have to, again, jump in, start to learn, read more books, listen to more podcasts, look at articles online, YouTube videos. Um, if you have any real estate forums that you like to go to, like Bigger Pockets, you can go there, connect with people in the certain areas that you want to, start asking questions. Again, if you have a local real estate investor in your area, take them out to lunch. They can be an incredible resource, incredible way for you to learn if you're looking at maybe in getting in your own area. So I know that I mentioned a little bit earlier about how I like to invest mostly in these syndications. So if you want to learn more about how I invest in those syndications, then you can actually check out this next video right over here, where I go over the basics and a complete overview of everything that you need to know before you invest in your first syndication. And I'll see you when you get there. Take care.